This is David Goldman, Asia Times Deputy Editor, speaking to you from New York City the evening of May 12th. I've been feeling like Johnny One Note for the past month, talking about nothing but inflation, and I was gratified to see a headline in the financial press today. Inflation isn't everything, it's the only thing, and it's certainly the dominant thing on the market's mind. We've been saying for weeks that the American government's official inflation indices are lagging the observed price increases in key items of the consumer basket. This morning, the Bureau of Labor Statistics reported a dramatic surprise on the upside, a nearly 1% increase in the core consumer price index for the single month of April, biggest monthly increase since the great financial crash of 2009, an annualized rate of about 11%, and that's the bad news. The worst news is there's more to come. One of the biggest components of the increase was, of course, used cars. Now, since used car prices are up by more than 50% year on year in the wholesale market, and up by more than 20% during the year to date, it wasn't a big surprise the government reported a 10% increase in used car prices. The enormous increase in housing prices, 12% year on year, big increase in asking rents according to private indices, 70% year on year. That is only beginning to show up. There was a slight increase in the shelter component of the consumer price index, but we expect that this key component, which is a third of the inflation measure, will continue to rise. So be prepared for many shoes dropping over the next several months. The stock market clearly didn't like that. The NASDAQ was down 2.5%. The other indices down somewhat less. The market ending at the session lows. Bond yields higher due to inflation expectations, also due to fear that the Federal Reserve eventually will have to raise interest rates. The least damaged issues were integrated oil, Chevron up slightly, Exxon down slightly, and the banks, Wells Fargo up slightly, JP Morgan down slightly. So we still think that financials and oils, which tend to thrive in an inflationary environment, are probably the best place to hide out, unless, of course, you're buying outright hedges, which I've been recommending, for example, ETFs, which move inversely with Treasury bond prices. The Federal Reserve is really in a pickle. As the chart shows, we have been we've had the worst month of inflation for about 13 years. The difference between now and then is that federal debt was about 30%, 25-30% of GDP at the time, and the deficit wasn't that big. Now we have government debt which is well in excess of gross domestic product, and we're running a budget deficit of around 15% of GDP. So if the Federal Reserve tightens monetary policy to suppress inflation, it will be much harder to finance the deficit. With this gigantic supply of treasuries, interest rates could shoot through the roof. And of course, if you have an enormous debt burden, any increase in treasury yields is going to cost the government a great deal more. So that would force a cut in spending, which is recessionary. So we're starting to look like Italy, or maybe some of those bedeviled third world banana republics that have spent too much and now see their budgets implode. And of course, if they keep printing money by buying all these treasury securities, and if the Biden administration keeps spending trillions of dollars on what it calls infrastructure, but ends up being childcare and subsidies for urban schools, then inflation will get worse. So the Fed is painted into a corner. There's no good outcome here. We'd be light on stocks. If you want to own stocks, we've mentioned the sectors that we like. We would be buying hedges in here. So as we've been saying, be afraid, be very afraid. This is David Goldman, Asia Times Deputy Editor, speaking to you from New York.